everybody. Welcome to Friday, another Talk Money with Tom show today. We will try our hardest today to help you have a more successful financially related retirement. We do that through answering your questions. We've been doing this for quite some time now. Really excited. Got some good questions that have already come in. But you can send in questions now if you'd like to Ask Tom at talkmoneywithtom.com. Or you can put it into the chat box here on the show, and we'll actually try to answer those questions live. And obviously you can send in questions during the week like others have this week too. So look forward to that. Obviously, we believe that education is an important component of understanding how to have a successful retirement. And that's why this channel's here. We feel like there's not enough information out there in these particular categories. And that's why we answer your questions in those categories too. But you can also go back and look at our channel. We have over 1,000 videos there in different categories. You can subscribe to the channel, hit the little bell button. You'll get notified when we put new content on as you continue your educational journey here. And then if you'd like, you can just meet with Ethan and I for 30 minutes of phone or video. You go to our website, hit the book appointment button, and you can come talk to us, individually if you have some specific questions that you'd like to ask as far as that goes. So looking forward to today. Hope we can help you with your particular questions. Go ahead and start sending those in. I do like to spend the first portion of the show just talking about what I saw happening in the stock market this week. And if you kind of look right over Ethan's head there, you can see this week has really just been kind of sideways.
Yeah, it's down 0.5% for the week.
Yeah, so up a lot last week.
Mm-hmm.
So there's a couple things there that I see. Number one, a huge up week and having a sideways next week, that's good, actually. Even though it's down a little bit, it's better than what we have seen quite a few times where it retraces so much of that.
Mm-hmm.
You can kind of see over my head here just to the side, there was like 4 big up days. It retraced that almost immediately. So we're not doing that, right? So that's important. And the market seems to be kind of bouncing here on the S&P 500 between 3,900 and 4,000. Right?
Yeah, it's a lot of mixed news, I would say, for the week. You have the seasonal trend from the election. We got job reports, spending, and then the Fed's coming out with their comments, and it's kind of been a back and forth.
Yeah, because there are all those issues are, on one side of the argument after the other, and the argument is inflation. Really, I mean that's the key thing everybody's looking at. So we got retail sales, earnings, and reports that came out. They were strong. Mm-hmm. It's consumers doing well. Now they're borrowing, because we're seeing really big run-ups in credit card debt. American consumers are really good at buying. So a lot of pent-up demand after sitting around for a few years, and people are still buying. And then, of course, we saw the unemployment report come out, which was low. Both of those say inflation could go higher, right? Mm-hmm. So the market doesn't like that. At the same time, we saw actual inflation report from CPI last week. Came out better than expected. Still high, but better than expected. Mm-hmm. And this week we saw wholesale inflation come out. It was high, but still better than expected. So they're talking about what they call peak inflation, where things have maybe peaked out and we're slowly going to start to come back down as far as that goes. And then, as you mentioned, the Federal Reserve is out in droves right now. So one of the things that is inflationary is the stock market going up. Mm-hmm. And so they are very interested in trying to help that come back down, and they have been through most of this time frame, and they're fairly good at it. They're coming out talking about higher peak inflation rates. Some of them were really high and kind of unexpected that were shown and what have you. So their next meeting isn't until December 13th, but this is their way to kind of come out and try to push down on the market, and it's been fairly effective as far as that goes. So what we're seeing right now, I think, is sort of just a battle between this good news for inflation and then this bad news for inflation. Mm-hmm. And so it's not clear. Yes, inflation looks like it might be coming down, but then there are all these other pieces that are precursors to the next reports that are going up, like jobs and job growth.
Yeah, with the Fed's comments, the betting odds or the expectation for the 0.75% raise in December is up to 25% from 16% after the last couple of days of comments.
Yeah, that's a good point, and that's, still likely to be a half, but the market the more the market expects a 3/4 point increase, for example, the more the market will pull back. And so the higher that odds get, the more the market will pull back, or at least go sideways in this case. So these are all important components. I think almost all of the major indicators that I look at for recession are showing recession. The 3-month versus the 10-year Treasury, the 2-year versus the 10-year Treasury. The leading economic index was just released today. It's now down for 8 months in a row. Very good track record at predicting future recessions. We have the ClearBridge, report on recession report that's been showing recession for quite some time, and so these are all components that are out there. Everything showing recession. Looks likely that we'd have something probably in the second half of next year.
Yeah, and we've had kind of like a mixed bag, I would say, from earnings reports. You had Walmart earlier in the week that's saying they're looking their expectations are quite, positive. But then the following day, Target says we're heading for recession and they're not doing well.
Yeah, it seems to be certain companies, because we got good reports from Lowe's and all of these different, retailers, and then a couple companies stand out. Target and Williams-Sonoma really got hammered, and so it's an environment right now that's very difficult to manage, and a couple companies are having a harder time managing. And Target's actually usually pretty good in this category, but Walmart did really well here, and Target not so much. So there is some mixture of what's happening there. I think we're kind of in this kind of transitionary zone. If you look at it, probably inflation does start to come down, and probably the job market starts to weaken, and retail sales start to weaken at some point in time. Earnings start to weaken, because of this recession that comes. I guess the next question is, is it already kind of baked into the pricing here? Because the market already knows all these things. It's looking ahead 6 to 18 months. We're very close to the 200-day moving average. Is this the beginning of the next new upward trend, or are we going to fail like we did with these other ones? And so that's really, because right now, if you look at what the market's doing, it's fairly stretched out to the upside. I have a whole scorecard, and say -4 is the highest it gets. It's at -3 right now, so it's not completely stretched out like it was back in August 16th in that last big run up there. So maybe a little bit more room to grow before it gets stretched, and then so far when the market gets stretched out to the upside, it's gone back, and then it gets stretched out to the downside, and that's been our market this year. Overall down, but these little peaks and valleys. And the run between the valleys and the peaks are 10 to 18%. It's huge.
Yeah, you can if you're a good trader and you're somehow able to time all the peaks and valleys, you could be making some serious money during a down year like this.
Yeah, exactly. And that's the difficult part of this, is that it's hard to stay out of the market when it runs up 18%. It's hard to stay in the market when it's down 28 from highest to lowest point. And so this is a difficult place. It's one of the reasons why we have a third of our exposure to stocks in the market right now, and not all of it, is just because there's just so many indicators showing possible issues. Yet you still probably need, at least in my opinion, some exposure here until we see this play out and how this goes. Does this break through the 200-day moving average? Does it break through that trend line, or not? And does it reestablish a new primary trend? Then you want to get back in. And again, be aware that the market is looking forward 6 to 18 months. And so you'll see all this news coming out and inflation and all that, and the market's going in the opposite direction of what that news might be, because things look bad. Inflation's, still here. Recessions are coming, and the market goes up and up. And I've seen this game before. So doesn't mean that this will be the time that happens. We might need to see. We never had what they call full capitulation, right? And that's one of the things that the market's been looking for. We don't have to have it, right? We did have this is a fairly big downturn already, from top to bottom there. Bottom was October, 12th. But nonetheless, right now, the, 1/3 exposure, market's a little bit stretched. There's one other good thing that's been happening. The China, iShares China ETF is up like 19% just this month, right? And that's because of some conversations and, little hints that maybe they start to deal with zero COVID in a different way.
Yep.
So far, we actually haven't seen that, and I don't know how they would deal with it in a different way, personally, because they're kind of stuck with an older population and not enough vaccine
beds,
and
yeah.
hospital, capacity for that. But it really, there are some pieces pushing to the upside quite nicely, and there are other pieces that are giving some warnings here that things could get worse. So we do have the PCE report next week, which is the favored inflation view for the Federal Reserve. That'll be for last month. It comes in late, but that could be better than expected. That could help the market. And then, of course, we get the next CPI report on December 13th. So,
Will there be big volume next week? Because it's a holiday week for the U.S. stock market, so usually trades during that week. Can we read much into it?
no, you have to be careful because usually the volume does drop down, and actually sometimes that creates higher volatility. And so you can get these kind of moves one way or another that aren't that critical as far as that goes. So, yeah, I don't know if next week's going to tell us a lot about what goes on with the market. I am always really careful around lower volume time frames. Wait until maybe after to see what happens. So, yeah, but it's been a good run. We're up, roughly 10% from the bottom there in October. That's great. Let's just see where this goes as far as that goes. All right, so that's the end of our summary from the market as far as that goes. Really look forward to be able to, have a discussion again the next time we get together, but we won't be here next Friday.
Yep.
Yeah, so next Friday we're going to be, obviously with Black Friday and Thanksgiving and what have you, but we'll be here, the Friday after that. All right, so what do we have for questions?
I'm saving for a big remodel in 2 years. Should I keep the funds for the remodel in cash or invest it?
Okay, so this is an interesting question. It comes up a lot, actually, within the client, strategy sessions that we have. And, what do we do with this money? We've got some big plan, buy a house, whatever it is. And so it's all about investing and how long you should be investing and being very careful with short time frames. I've seen some pretty funny videos out there with people that are basically pretty assured they can make money, in a 2-week period. And and there are periods of time where the market's crazy and that does tend to work. But, you got to kind of play the odds. So we do have a slide for this. And I should make that one of my sayings. We have a slide for this. Anyway, we're blocking the last part, but not that critical here. I just wanted to be able to see it because it's kind of dense data. So if you look, this is going back to 1871. This is coming from lazyportfolioetf.com, which is kind of a good website. But what it's showing here is a conglomeration of different indexes, because the S&P obviously only went back to 1957. But so it's the Dow, the S&P, and probably the total stock market index with Vanguard. But what it's showing here is that the best 1-year period was 164%. Well, that's pretty good. So if I had a 2-year period, the best one's 59.68%. That sounds great, right? I could put my money in there for my house or remodel. But the problem is the worst 1 year there is negative 55%. And maybe the most telling is how many negative periods. 19.5%. So it's kind of interesting. It's a betting game. So you have a 80% chance of making money in that 2-year period. That's not terrible, right? But that negative 55 is hanging out there as a possibility, so that's kind of high. 5 years seems like the best criteria for a investment into the stock market. If you look at that, the average, the best year was 37%, right, over that 5-year period. That's the best 5-year period. And then we've got, 10% of the time it went down, and the negative 19.58. So I would say no. Right, in terms of putting money into the stock market for a 2-year outlook, cash would probably be your best bet as far as that goes.
Yeah, unless you have some other way to replace the money. Say you somehow earn enough money that this small amount of money, wherever it drops, you could replace.
Right.
Then maybe you could take that risk. But usually for big remodels or down payments, you can't afford to take a loss.
Yeah, exactly. I mean, the reason you'd want to put it in the market because you need the money, because it's expensive and you're hoping to make something more than what you could make at the bank. But you could, you could suffer a big loss. It is about probabilities. It is about your other opportunities if those probabilities don't work out, right? I mean, there's a bunch of pieces there that are kind of important. But this is a cool chart. If you look at it, look at the 10-year there. 2.9% of the 10-year periods were negative. So really good chance you're going to make money. And the average rate of return is 9.2% on this U.S. stock mixture, right? So longer term is higher probability of success, and it's why it's great for retirement plans and things like that. Not so great for short-term goals.
Yeah, and you'll probably hear some like stories from friends or family that have taken these risks and they've come out positive. I don't know how many times you've heard the horror stories of messing this up, though. Yeah, exactly. That you hear the good stories at the cocktail party. Somebody's bragging about how they, did some options or did some particular thing with the stock market that helped them pay for the house. I did with the stock, but that's a little bit different. It's not something I would recommend. Right over my head there, I just noticed one number here that's kind of interesting. Look at that. The worst 20-year period is actually positive. So there hasn't been since 1871 a 20-year period where there was a negative rate of return. That's pretty impressive. So if you're a younger person and you're worried about what's happening with the market, and you have 20 years before you might really start needing the money, it's still a good time to be adding to your 401ks and those types of things. Yeah, and even if you're just getting close to retirement, with life expectancies, you could be living for another 20 years. So you still want some exposure.
Oh, yeah. Yeah, you bet. You bet. All right, what's our next question?
What are the 5-year rules for Roth IRAs?
So Roth IRAs, you have two different ways you can put money into a Roth IRA, right? If you earn money, and not too much money, because there is a limit, then you can put in $6,000, and then there's another 1,000 catch up if you're over 50, right?
Yep.
So you could put $6,000 to $7,000 in if you earn money, but there are limits to if you earn too much, then you can't put in anything.
Yeah, it phases out. I think it's around 144,000 for a single,
right?
288 for a couple, I think.
Right. But so there's a set of rules around that money, and then you can also convert, and this is any age and any dollar amount, no matter what you make, right? That's cool. You can convert from a regular retirement account, like a 401k, regular IRA, whatever it might be. You can convert that into a Roth IRA. It's taxable upon conversion, but then it grows tax-free thereafter. But there's different rules. So let's start with the contribution, the $7,000, assuming you can do it. What are the 5-year rules there? How does that work?
So it's 5 tax years, which is a kind of weird term, I would say. But the IRS says if I make a deposit in November, say today, it still counts as January 1st as the account being opened. So you'd have to wait for that 5 years from that January 1st to be considered 5 years. And if you were to take money out prior to that, it would be considered any earnings on those contributions would be considered taxable. And then you'd also have a penalty if you're under 59 and a half.
So if I open an account today in November of 2022, you're saying that my 5-year clock doesn't start until January of 2023?
No, it'd be January of 2022. So
2022. So basically, I might have to wait less than 5 years in total from today. Okay, that makes sense. And then, and so that's fine. And obviously, if you're under 59 and a half, there's a 10% penalty. That's pretty common all the way through all the tax law. But the one differential there is that, the tax-free growth, and they want you to keep it there for 5 years. They're just trying to encourage people to actually invest instead of trying to game the system, right?
Yeah, it was put in place. Essentially, people are abusing it. In a sense, if I take money out of my 401k and convert it, it's now considered a contribution to an IRA or a Roth IRA. And you can take out money from a contribution as tax-free. And so people were essentially converting their 401k into Roth accounts and then pulling the money out for some sort of project. Yeah. And it's not abusing the system.
Yeah, so that changed. Now let's talk about a conversion. So when I convert an asset over, what are the rules in terms of, the taxability nature of that?
So you have to wait 5 years after conversion to then withdraw the money for it to be tax free.
Yeah.
So the way it works is if I converted this year, I'd have to wait till 2027 to pull out the money. And then if you don't, it'd be taxable income on the earnings again.
Yeah. Now, is there some advantage to opening up an account earlier? So, I mean, obviously, if I don't have an account right now and I do a conversion right now, I'd be opening up an account. But let's say I'm thinking about doing a conversion next year. Is it still a good idea to open an account in some form or fashion? Because does that get the clock started?
Yeah.
Or does the clock only start on that conversion?
So so for the open account, it starts whenever you open the account. Conversions it doesn't matter. The 5 year clock starts at the conversion date.
So each conversion will have its own 5-year clock?
Yeah, and so the IRS looks at it first in, first out at least.
Got it.
And so if you were taking out 5 years from now, it'd look at your first conversion rather than your last conversion for the funds.
Got it. Now, how about the contribution, the $7,000? Does it make any difference to open the account earlier?
So if let's say you're 57 and you want to start pulling the money at 60, you'd still have to wait till 62. So if you open it earlier, you don't have to worry about that kind of period of time.
Got it. Okay. Welcome to Tax Law 101 here, all kinds of things. Here's another question for you. Let's say that I do a conversion, I pass away 3 years later, my beneficiaries it's still in that 5-year window.
Mm-hmm.
What happens to them?
So for beneficiaries, for conversions, you don't have to wait the 5 years. It becomes tax-free. Usually, if you're a beneficiary, we'd recommend you hold on to that IRA as long as possible before you pull it out because it's tax-free growth.
Yeah, I had that conversation as I converted my assets to Roth with my kids saying, it's so hard to get a 10-year, to get tax-free growth. You should leave this asset unless you absolutely need it, for the full 10 years to get that growth. And then you'll be forced to take it out at the end of that period, but don't take it out early unless you absolutely have to. So, that's the big advantage. So, okay.
Yeah, and another thing, say I opened the account this year and then I've only had it and then I pass away in 3 years. What happens to the beneficiaries? So the beneficiaries would still have to complete that 5-year window.
And this is for contribution.
For contributions.
Contribution. So contribution, they have to complete the 5-year window. A conversion, they do not.
Yeah, essentially when you open the account, you get that 5-year window.
Got it. Okay, that's clear. So good. Well, thank you. That's a good question. Let's see what the next one is.
Why is the Federal Reserve's comments so aggressive when it's coming to interest, and why they're trying to push so hard?
Yeah, okay, so think about this for just a second, and I'll go back to sharing kind of the stock market chart here just so we can use this as a reference. So the Federal Reserve is trying to bring down demand, right? And so they can't control supply. Supply is getting constricted in China. Supply is constricted in general around the world because we reopened so quickly and demand moved up. People were willing to spend money faster than they could produce all these things. Even just getting airline pilots to come back and, provide services. And so one of the things that they look at in terms of demand is how do we make your house worth less so you have less home equity? And how do we make your stock market worth less so you have less money in your 401ks or whatever it might be? Because all of those things tend to weigh in on consumer psyche, and they're hoping that we start spending less during that period of time. And so doing that might bring down inflation. And one of the problems is that, they don't really want to raise rates that much because that does raise the rates that they have to pay on government debt. They locked in a lot of really low rates here at these low periods, but they always have new things coming due. So 3-month T-bill is now over 4%. They're having to pay over 4% on that T-bill, whereas a year ago it was less than 1%. So one of the ways that they do it, we call it jawboning, right? Where they talk aggressively and say things that normally would disrupt the market, and that's the object of what they're trying to do. So there was one of the Fed governors from St. Louis who had a slide in a presentation that showed the peak rate would be 5 to 7%. Nobody's been talking about 7%, right? They're talking mostly about 5.25. Larry Summers came out and talked about 6%. So here's this Fed governor, and this brought the market down some, who has a slide showing 7. Why does he have that slide? Well, it's possible we do get to 7, and I actually think 6 is kind of likely, but it helps the scenario. The more the stock market goes up, easier monetary situation gets, the more inflation stays entrenched, the more they can bring down the stock market, the more it helps with inflation, which is their main goal. So if they can bring down the stock market and the real estate market, we just had 9 months in a row now. We've had a decrease in the home sales, and that's a good thing as far as they're concerned in this environment. This stock market is down here, even with this run up, about 18%, so it was down 28%. That you'll notice they do more interviews, they do more talking at the peaks here. We saw that true in the August run up, and we're seeing that true here. And so that's why, if they can use their words to bring down inflation without having to increase the rates as much, that creates lower costs for government debt, and it creates a better scenario just in the terms of when you raise rates a lot, something can break.
Yep.
I mean, crypto might be breaking right now as we talk. It's certainly having some struggles. And so, again, those are the types of things that can happen when you raise rates or even when you bring down the stock market. So that's why it's a very good question. It's very interesting, to kind of understand what is happening here. It's one of the key forces that we're fighting. If we hope that the market's going to go up, which I do, I like it better. It's fun, 2020 was fun, especially for the, after the big downturn. And so, but we're fighting against the Fed, not just the fact that they're raising rates and talking about raising them more and talking about increasing the peak amount. It's just literally the conversations that they're having and the way that they're saying it and how aggressive they're being. We're fighting against all of that. The headwind is amazing. Now, we still come up 10%.
Yeah.
Since the middle of October. They can't jawbone this market down completely, but it'll make it harder for it to go forward, believe me. So that's a good question.
You can see how reactive they were this week because mortgages dropped to what had the biggest decline. Their 30-year, it went from over 7 to 6.61, I think was percent. And so that's a big drop when it comes to interest rates.
Yep. Yeah, exactly. And that isn't what they want.
Yeah.
That's, unfortunately, that's what we want, right? All of us, and we all want the stock market to go up. Yep. But that's not what they want right now because it's all inflationary. So you just have to understand. It's why we only have a third of our total stock market exposure in, and might turn out that that's too much if the market turns around here and goes back down. But we're not 100% back in because of lots of different pieces, but one of the main ones is that headwinds of fighting the Fed. Because when the Fed is behind the market and helping, boy, it can really move like it did in 2020. They lowered rates to 0. They started buying bonds with quantitative easing, and we had a phenomenal run and a great run in 2021 also, right? So it's just the opposite right now. And they would be very happy to see the market get down, substantially from where it is now. Especially if something didn't break, right? Because, I don't know, maybe they even want something to break. One of the Fed governors did talk about we can't worry about financial conditions when we're trying to do this. And essentially what he was saying was that, if something breaks, that's okay. In a way, I'm paraphrasing here, but if something does break, that could bring down demand quite drastically. Like at Lehman Brothers broke in 2008, unemployment went shooting up. All kinds of businesses are struggling, going out of business, and probably people pull back in their spending in that environment, right? And all of a sudden we get, a 2% rate instead of these much higher inflation rates, and so whatever it takes. The problem is that they can break things so badly, you end up having just the opposite. They had to bail out, the country at the bottom in 2009 and such too. So. It's a tightrope that they're walking on here, trying to get to the other side without falling off and creating a big downturn.
Yeah, the Fed really doesn't care about the stock market. They care about inflation and people being employed.
Yeah, those are the two mandates. Their mandate is not to make the market go up or what have you. It is to keep inflation in that kind of 2% zone, and to have full employment, what they consider full employment. And so, right now, making the stock market goes down helps the inflationary standpoint. Probably doesn't help on the employment part, but employment's only at 3.7%. They consider full employment kind of in that 4 to 4.5%, range. So they feel like the market's already too tight. They got some room to push. Of course, that's like 1 million jobs lost. When you do the actual numbers, it's kind of incredible. So there's some people that are going to suffer from this, scenario. But inflation, I mean, right now they just announced in England, the inflation was 11.1%, and they're saying that in England right now, this is one of the worst economic environments in recorded history in England for people that live there right now, dealing with all of the different pieces that are coming at them. So, that's where inflation can really, really hammer everybody. And so it is important to get it under control. Unfortunately, it probably means raising the unemployment rate. And the unemployment rate went down this week. So, that's another problem for the market.
Does the market like the results of last week's midterm elections?
Okay, so we talked about this at the last show. Historically, when you look at the stock market, really kind of from the middle of October, which is right where this market bottomed out, to the end of the year, I think the average rate of return was something around 10% on the S&P 500 over the last 70 years. Mm-hmm. During the midterm election, one of the things that came up was kind of interesting. Since the Great Depression, only two times has the White House had the full Congress and kept it. And so what that means is every other time the White House, that whenever they had the full Congress, all of a sudden it's been bifurcated. And that's what's happened here. The Democrats have the White House and the Senate, and looks like, they're going to have the Republicans are going to have the House.
I think they called it for the Republicans, right, for the House.
Yeah, so that's that bifurcation. So if you just draw the lines there, normally the midterm election market goes up. Normally the midterm election results in a bifurcated Congress. The market likes bifurcated Congresses, and there's reasons for that, right? We talked about this last week, but the less things get done. Very likely that the corporate tax rate isn't going to go up in this environment, so they like that. It's quite low right now. There was some talk about pushing it up quite a bit during this 2-year time period. Didn't get there, but so that's a known now. Went from, maybe they'll go back to 28% from 21 to, hey, it's going to stay at 21 at least for the next 2 years. So there are now things that are kind of locked in, and as a business, that's nice to know when you're doing your planning. And so there's, a logistical reason why the market likes a bifurcated Congress. As a person, we get frustrated because they're probably going to be, less accomplished.
Yeah.
Right.
Because Republicans prefer to cut taxes and cut spending, while Democrats are kind of the opposite. They want to increase spending and pay for it with more taxes. Usually on someone who's above 400,000 is kind of their goal.
Yeah, for this particular administration. Yeah, I think the one thing that'll be interesting though is what happens when it comes to the debt ceiling, because there's been a lot of rumbling about not wanting to let the debt ceiling go up or using that as a leverage point to cut spending in different areas. Does the stock market, because stock market likes a bifurcated Congress, okay, great, but stock market hates the debt ceiling argument.
Yep.
So we just put in a group that has said they want to fight the debt ceiling piece, but there isn't a big majority in there, so maybe that helps. Just because it does take a lot of people to really make that a threat effective. But we've had so many debt ceiling discussions that have caused the market to go down, 5-10%, and then come back, so that's fine. But the real fear is that actually letting the debt ceiling expire and ending up with some defaults. Anyway, that'll be something to look for here as time goes on. But yeah, at the moment we have a seasonal updraft that is probably helping the market since the middle of October, and we are up 10%, from the middle of October also here. So, that is there. It is still there, and I think the market did like the eventual outcome. whether you did or not politically is a kind of different story, but just in terms of what the market looks at.
I'm getting close to retirement. Which insurances should I think about stopping?
Okay, so I'm going into retirement. I've got some different insurance, that I'm paying for now. Maybe I'm looking to reduce expenses or something, right? And so, obviously, there's not a lot that you'd reduce. You're not going to drop your medical. You're not going to drop your
House or
house
car.
or auto. Dental is one that a lot of people don't do. I'm not a dental insurance expert. I'll just tell you that my clients, almost none of them have dental insurance. A lot of good clients, very savvy engineering type people that have done the analysis, and they just don't think it's worth it, so they just save for possible cost. And we even include those in their plan if they don't have dental insurance. So that might be one that gets dropped. Life insurance is sort of a case scenario.
Yeah, it really
Right.
depends.
Yeah, I mean, I have life insurance because I want to make sure my estate has liquidity and for different reasons and things that I want to have in place. And I have a permanent policy that'll be here for as long as I make the darn payment, right? And I plan on keeping that going even in retirement. But there are some situations where you might look at that and see that maybe you don't need that,
Yeah,
term policy or whatever it is.
Yeah, you could have your house paid off. Your children are, started their careers. They're already stable, so they don't really need any kind of support from you. And you have a nest egg that would cover both you and your spouse, if you had a spouse.
Yeah, I'll tell you what, I always get really nervous in this conversation with clients because I don't want to be the person that says, oh, you should drop that $500,000 policy that, they're usually not paying that much for
Yeah.
if it's a term policy. And then that person passes away, and then the beneficiary sitting there looking at you like, well, what did you do that for?
Yeah.
So I'm always, that
Usually,
makes me nervous.
I'd say for term, if you have term that's cheap, I would just let it run its course.
Yeah.
Because at that renewal point, it'll become too expensive to actually keep
Oh
going.
yeah, once they get to the end of the term, they jack the rates up so much that you can't usually afford it. So that's fine. But the one thing that does jump out is disability insurance, right? That's replacing your work income, and because you're working now, you're retired, so that's definitely one that you don't need.
Yeah.
Yeah. So, maybe the dental, maybe look at the analysis on the dental, but and then the other one would be just the disability. And not a lot of people have disability, actually, but if you do, that might be something you don't need once you're in retirement. I think life insurance is a toss-up. It depends on your situation. The rest seem like the rest that I can think of makes sense to keep throughout retirement. But yeah, good question.
What is a bond ladder, and should I use it over a bond fund?
Okay, so this is a good question. It comes up in strategy session meeting. So a bond ladder, you'd say, okay, I'm going to buy a 1-year T-bill, a 2-year T-bill. I'm going to buy a 3-year T-bill, a 5, 7 type of thing. So that's my ladder. I have a 7-year ladder. I've got things coming due, let's just say every year, just to make it simple. And so the idea would be that I don't have to worry that much about the fluctuation of principal because if I'm holding it to maturity, I'm going to get my money back. Depends if I bought it at par value. It gets kind of complicated, but more or less, I'm going to get my money back. And I'm going to make this interest during that period of time. And then the object would be that, at the end of that year, that first one's coming due, I'm rebuying another one for a year. And if the rates are going up, then I'm locking in, higher rates. And so it just kind of spreads the risk of rate change. If rates come down, my 7-year looks great. I've been sitting there at that higher rate for 7 years. If rates go up, the fact that I've got one coming due every year looks good because I'm able to lock back into higher rates. Does that make sense? So there's an advantage there as far as that goes. There's all kinds of things that, from an income standpoint, is the interest enough income for you, or are you having to do kind of a systematic withdrawal of the whole program? Because some of those can grow in value, right? So that's the differential. So in a bond fund or bond ETF, there's a big basket of bonds that you're buying into. Now they're maturing, but it's such a big basket you can't really tell. and you are subjected to price appreciation or depreciation on that bond allocation, as well as getting this dividend. But there is no maturity point in the future.
Mm-hmm.
So if interest rates are going up, the value of bonds go down. A ladder looks good in a rising interest rate environment. When interest rates are going down, the ladder has some nice longer term pieces in it, but the bond ETF and the bond mutual fund, for example, are actually going up in value. So you can play them as at least a small appreciation vehicle in the right environment. And so I guess the only other thing that I think about there is that the bond fund or bond ETF, it's a lot easier to deal with.
Mm-hmm.
You're constantly having to, redo these ladder pieces and what have you. It's not that difficult, but a bond ETF, for example, you can kind of set it and forget it for the most part and kind of hang in there with it. And you want, that complement of that possible appreciation when the stock market goes down. Didn't work this year.
Mm-hmm.
They both went down because in a high inflation environment, real estate goes down, stocks go down, and bonds go down, right? And cash goes up. So that's a good cash, money markets, CDs, and those type of things are certainly going to start to do a lot better here.
Do bond ladders and bond funds have similar returns, and it's just kind of that appreciation is their difference, or would they have different kind of
Over a
incomes?
long period of time, they've got to have a very similar return, actually. It's just a matter of dealing with that fluctuation in between time. So, in 2020, the bond funds looked great, and the ladder was not that great, right? Because the appreciation in the bond funds was spectacular because they were lowering interest rates.
Mm-hmm.
In 2022, the bond funds look terrible because this is one of the worst. I saw a stat showing for the 10-year Treasury bond, which has a really long track record. It goes way back. This is the worst market we've had for the 10-year Treasury since 1788. So it's a really bad year for the overall bond market, and a ladder looks better in this environment. So I guess that's why we're getting asked, because the ladder looks better in this environment. But a lot of times, by the time somebody does something, we're already on to the next phase. Mm-hmm. And once they do start lowering rates again because things start to slow down too much, then that bond ETF will look better. So both is not a terrible concept, right? Depends on how much money you have is whether you can do that. But having a split between a ladder and some bond ETFs, that's not a bad solution. It kind of bridges both sides of the argument.
Mm-hmm. How is income generated from my assets in retirement?
Income generated in assets. Okay, so I just had a conversation with a friend that's in the business and has a client who is just retiring, wants to put the money into dividend-paying stocks, for example, and because he needs income. So they're looking at, okay, bonds that pay income and dividend-paying stocks that pay income because that's what I need. I need to get income. Now, the problem with that philosophy is that, for example, with dividend-paying stocks, the highest dividend-paying stocks are almost all in one category, kind of large value type companies. And a company pays a lot of dividend because it's not growing much. And that's the way they attract money into their stock, which is great. But if large value starts to do poorly, you're going to lose a lot of principal, even though you might be getting a good income. And so some people would say, well, that's fine. I'm getting my income. If value drops, who cares? I'm not using the value. I'm getting a dividend. But what I have seen throughout my career is that when the value drops enough, so does the dividend. And so the companies in 2008, lots of dividend cuts, bam, 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 bam. So now you're stuck, right? Not only have you had the value fall, maybe more than normal because you're concentrated in one area, you've also had your income fall. So you gotta be really careful, and dividend stuff's really hot right now. I have no problem with dividend for a portion of portfolio. I think it's a great idea. It's just part of that diversification. It does produce income. Some of these companies really have been really good about keeping their dividends up and what have you too. So but having, the questions we're getting are like this massive contract, but everything there. I wouldn't do that. I like the more diversified component of it. So far this year, say large value has done well. But every time we've had a big run-up, it's been the growth side of the equation that's done well. So March run-up, growth went up more than value by a lot. The August run-up, the summer here, growth did way better. So far in this run-up that we've got going on right now from the bottom of October, growth did better. And so I'd be really concerned if I put everything I have right now into kind of large value into these dividend players, that the market takes off. I could have made a lot of money on the growth side. Now, you shouldn't have everything on the growth side either. So it's that balance. But that's where I think the danger is as far as that goes. So the best way, in my opinion, to generate income is to do what's called a systematic withdrawal, where we create a balanced portfolio, growth, value, different types of stocks, bonds, et cetera. And then we set up a distribution right out of that account as a whole. So the dividends and interest and what have you go into the money market, and that gets paid out as a payment. And if there's more needed, maybe once every 6 months, we sell a few shares to replenish the money market. And, if you've got a portfolio that averages 7% and you're taking out 3 or 4, just as an example, that works. And that kind of allows you some growth and some more balance. And you don't get stuck in these scenarios where, large value just gets hammered, which can happen.
Yeah, you're not putting all your eggs in one basket.
Yeah.
And
Yeah.
it's so, and if you want to add more diversity, you could look at annuities or something else that could generate income too.
Yeah, exactly. All right, well, that's our show for the day. I want to thank everybody so much for coming today. Again, we will not be here next Friday. Obviously, it's a Thanksgiving holiday. We'll be here in 2 weeks, and look forward to seeing you then. Again, you can send in your questions though anytime you think of them to Talk Money with Tom. Ask Tom at talkmoneywithtom.com, or obviously take a look at our channel. Subscribe to the channel. Hit the bell button. I think you'll be well rewarded. Your education will start to grow in this area. And then lastly, of course, if you want to meet with Ethan and I, you can go to our calendar, hit the book appointment button, and set up a time to meet with us, and look forward to that. So thank you very much for coming today, and I really look forward to seeing you in a couple weeks.